All right, let's get to it. Welcome to another webinar on financial planning. I'm so glad you're here, wanting to talk about finances so early in the year. Financial planning is really about getting to one big question, which is this: are you going to go through door number one or door number two in your life? Door number one means you're going to be able to afford everything you want to do in life. Door number two, you're going to miss out on things. Now, I can't guarantee you that with financial planning, you'll make it through door number one, but I can guarantee you there's a much greater likelihood that you'll go through door number two without any planning, just like anything else in life. What is financial planning? That's a good question. You know, what is this esoteric thing? It's a lot more than investments. We're talking about investments today, but it's a lot more than that. Here's how I look at it: 4 areas. Protect what you have. Know where it goes. That's the spending. Make it grow. That's the investments. Retain independence and dignity. That's projecting cash flows out through your life. Now, protect what you have is insurance, estate planning, all of that. I mentioned spending, investments, and then retain independence is knowing that you're not going to live off your kids in your older age. We do all of this with intention and purposeful effort, and we're building your best financial life, not the best financial life on your block, but your best financial life that you can have. Here's the process that I use, and I only put this in front of you because I want you to see where investments fits. It's very low on the totem pole, and it's a very small area. We only cover it after we know where we want to go, what we know what our spending is, we know what our expected cash flows are. Then we wedge in investments and say, okay, this is what we could do on the investment side. We'll see how that helps us with our lifetime cash flows. What does long-term mean? We only build portfolios for the long term, and here's what I mean by that. Long-term, I think a great starting point, at least, is that it's 5 years from now. So if you have money that you plan to spend in the next 5 years, it should not be invested at risk in a portfolio. If you have, let's say, $200,000 sitting in your savings accounts and you're going to buy a house next year and it just pains you to not earn any money on that $200,000, guess what's going to pain you more? If you invest it and the 200 goes down to 150 or 120 and you're not able to buy the house next year. And especially since if that happens, home prices have probably dropped next year and you're going to feel double pain. So if we have money going out the door, we want it in something safe. We don't care what it earns. Its job is not to earn money. Its job is to be there when we need it. That's all the funds that we expect to be going out the door in the next 5 years on a net basis. Now, why do we talk about a long-term portfolio? Well, because we can't predict the short term. Nobody can. A lot of people will tell you they can. A lot of people will show you history. Look how we did. Look at this performance. Isn't this great? But over time, they don't hold up. They all blow up. They don't hold up. They blow up. So unless we're investing in something very, very safe, we can't predict what the future returns will be. And if we're investing in something very, very safe, our returns will be low by definition. So we're talking about, on the safe side, mostly checking savings accounts, maybe CDs, although there you can't really get to the money. So what's the point? But really savings accounts, and then our long-term portfolio for money that we're going to spend at least 5 years from now. And we do this because we know in the long term, even though we don't know what returns are going to be in the short term, in the long term, returns we expect to be positive, not just positive, but to beat inflation. Why? Because they always have. And why is that? Because what we're investing in is a group of companies run by people, boards of directors, CEOs, all the way down to every employee, who are all trying to make money for us. We're the owners, we're the shareholders. Their objective in running the company is to make money for us. These portfolios, these investments, groups of investments, large number of companies, certainly they will swing from time to time. They will go down, but they have never stayed down. If you've heard the phrase, the market's at an all-time high, it probably made you nervous, but guess what? It's almost always at an all-time high because it goes up, and that's what happens when it goes up. It creates all-time highs. Now, That's not exactly what most people do. What most investors do is they use their emotions, they use their gut feeling, they go on hunches, they go on tips, they maybe they do some analysis. That doesn't happen a lot, but maybe they do. But believe me, they're not doing as much analysis as all the other people that are out there, the professionals and on. So they can't beat those other people. So instead, they're swayed by their influences, the things they learn, and certainly the media. The media is the worst. And what this means is that we end up investing on our emotions. Now, what happens when we invest on our emotions? Well, when stocks are going up, we feel optimistic. When they go way up, we feel great. And what do we do when we feel great? We buy. Well, do you think this is the right place to buy? Probably not. As they go down, we get nervous. And then way down here, we get fearful. And what do we do down here? We sell. Now, is this the right place to sell? Probably not. So we end up doing exactly the opposite of what we should do. And what we're missing here is we're missing an investment philosophy, something that is written in stone that we believe will be true in all times, good or bad, that we can go back and point to and say, you know what? My emotions are telling me to do this, but my logic, my philosophy, what I know to be true is telling me to do this other thing. And without that philosophy behind and backing your investment strategy, you're just lost at sea. So let's talk about an investment philosophy. So what is an investment philosophy? It's something that's true in all seasons and it's executable in an actual portfolio. It's not just theory, okay? So it's gotta always be true and it's gotta be something we can actually act on. So let me share my investment philosophy. And I'm gonna get a little historical on you. So in 1906, Francis Galton, he's one of the founders of modern statistics. And if you look him up, he's not an all around nice guy, but he was a great statistician. He went to this fair in Plymouth in the UK, and there was a farmer there, who was having people guess the weight of an ox. And whoever guessed the weight or got closest would win the ox. Well, there were 800 guesses and nobody really got close. The actual weight of the ox was 1,198 pounds. The average of all those guesses was 1,197, almost right there. Actually, the person who won wasn't even that close. So the knowledge that was embedded in all the guesses was greater than the knowledge in any single guess, even the best guess. We call this the wisdom of the crowd. This happens, you see a lot of examples like this. If you ever see those things where they're guessing how many jelly beans in a jar, it always happens this way, where the average of the guesses come out to be better than the individual guesses. Now, why am I talking about that? Well, what is the market? The market's setting prices every day. It's people guessing what the price of individual stocks should be. $440 billion traded every day with people guessing the stock should go up, the stock should go down. That's a lot of knowledge out there pushing prices around. What makes us think we're smarter than all of that? We're not. Even professional investors who are paid to be smarter than all of that are not. It's never been proven through an academic study, a rigorous study that says this investor, this decision maker has made statistically significant difference in terms of his return versus random choices. So it's not. The investment industry is a lot of marketing, and what we need to do is something that's a little bit more rational. Now, so that's one point. We can't predict the markets. Not only that, nobody can. Let me go to another point. What are companies? What do companies do? Well, I apologize for reading this slide, but I can't think of a better way to say it. Companies exist to make money. Okay, duh. They do that by offering services and goods that are in demand, and they offer those services and goods at a cost that are affordable to the consumer and profitable for the company. Now, all four of those things have to be true or the company disappears, goes out of business. Every single company has to do this. They have to make money. They have to offer goods and services that are in demand. They have to price them that are affordable to the customer. Customers can gripe, certainly allowed to do that about the high price of gas or whatever it is, but they still buy it, they still afford it, and it has to be profitable to the company. Now, companies as a structure don't exist outside of human beings, right? So companies are made up of people who are contributing their efforts to create these goods and services and provide them to customers who are also people in exchange for a small slice of the profit. That's what the company takes out of it, is the profit. So the employees get paid, the customers get what they want, and the company takes a slice of profit. That profit goes to the owner of the companies. Guess who that is? That's us, right? So we're owning all of these companies. They're making money. We're earning the profits from what they're doing. So, all right, so let's put that together with the wisdom of the crowds, and let's review what the investment philosophy is. Here it is. Humans are designed to connect. Since the first two cavemen got together and said, I'll hunt, you fish, we'll share resources, humans want to connect. That, of course, exploded through the 1800s and the 1900s and the 2000s with just the advent of travel and economic theory that allowed businesses to come about. And then the internet, of course, blew that up. And COVID, of course, has put a little dent in it. But the reason we all feel so bad about COVID is we want to connect. We're designed to do that. Companies are designed to allow those connections and enable those connections in exchange for profit. So humans always want to connect. That is on an upward trajectory. Companies allow those and enable those connections in exchange for profit. And so what do? And also, we can't predict which companies. We don't know which companies are going to do well. We don't know which company is going to go up tomorrow, down tomorrow. So what do? We're going to own them all. We're going to own all public companies we can. Why public? Because it's cheaper to own public companies. And we want to keep our costs down. And we want to keep our bookkeeping down. We don't want to end up with a mess in terms of what we own. But we want to own everything around the world. Companies in Russia, in Africa, in the US, companies in Mississippi, companies in Alabama, companies in California, wherever it is, Asia, everywhere and anywhere, those companies are enabling connections, making profits, and we want a piece of that. And the reason we want all of them, again, is we don't know which will do better. And so we want to be diverse. That's what being diversified is. Now, for this to work, there's 3 principles that you have to follow. You have to have faith in the future. What do I mean by that? I mean that when things go bad, you have to have faith that they will get better. You don't have to know how they're going to get better. You also have to have patience. You don't have to know when they're going to get better. You just have to have faith and patience that they will get better. The third thing is discipline. You can't be pulled away into what's hot right now, Bitcoin and crypto. Okay, so a lot of people made a lot of money in there. Don't know if that's going to continue for the next 30 years or 40 years or how long you have to fund your retirement. What I do know is that in the past, this has worked for 100+ years. And there's no reason to think it won't work in the future. So we don't want to get pulled out of what works all the time into something that's just working now and may not work in the future. Right now, it's crypto. In the past, it has been all kinds of things, from different types of real estate strategies to collectibles to artwork, whatever you name it. We want to do things that work in all seasons so we don't have to play this game of trying to pick and choose, because we realize nobody can. Then there's also 3 portfolio practices. This is what I do for my clients, but if you're doing it for yourself, you also have to do this. So pick the asset allocation. You need to structure a portfolio so that when the market crashes, you won't freak out, sell everything, and abandon the strategy. That's the way you lose. So we're going to limit our upside by limiting our downside so that we can maintain the strategy through our life. Diversification. We want to own as many things as we can, keeping our costs low, as I mentioned. The portfolios I put together have 10,000 or more companies in them all around the world. Rebalancing, that's the ongoing management. If we say we want 30% in this asset class or in this fund, that's not going to be 30% every day. In fact, tomorrow it's going to be different because they all move different. And if we go from 30% to 35%, that's great. That means it went up. but it means we need to bring it back down to 30% before it drops. Because if we do, or if we do not, we're taking on more risk than we wanted. So our risk profile, our actual risk will change even while we do nothing. So we have to do something in order to bring that risk profile back to where we want it. So there you go. I got 5 more minutes and oh my God, so many slides. All right, so I'm gonna go quick. So I mentioned how we lose. So here's a conservative strategy. Here's how we lose. Market crashes. We never thought that we would experience this. We sell. Not only do we lock in those lows, look what happens after every market crash. That's when the good returns are. We miss all of those. And then we're left on the sidelines wondering when we should buy back in. And boy, that is no place to be. One thing to know is that the market goes down 14% every single year. At some point during the year, on average, it goes down 14%. Last year during COVID, it was down 34% at one point. But if you look at from January to December, it was up 16%. So it does not go in a straight line. We just know that over time we get those higher positive returns, but we're going to experience those bumps and bruises. That's the price we pay to experience these uptrends, to get these gains. Now, one thing I want to share with you, if you were born 1970 or 1980, I just went back and looked at what are the returns of investments in stocks versus other things. 11% per year from 1970, 12% per year from 1980. If you go back 100 years, you'll find similar numbers. More recently, it's actually been, well, last year we were in the 20s. In a short period of time, it could be a wide variability. But over these long periods, it kind of averages out to 11, 12, I think is a little high. If you go over, look at other 30 and 40 and 50-year periods, it's more like 8, 9, 10. So, but anyways, look at real estate, 3 and 4%. Look at gold, 3%, 8%. That's pretty good, but you know, that was all the inflation we had in the 70s. Nobody wants that again. Inflation itself about 3 to 4%. So we're beating inflation, which means we can buy more things tomorrow than we could today with our money, and that's what we want. Another thing I wanted to share, somebody I call the last dumb buyer. Okay, so maybe not a very politically correct way to talk about it, but let me explain it. I think it'll make sense to you. The last big market crash, you know, we had the Corona crash, right? But it came right back. But the last big market crash was 07, 08, 09, that period. If you had bought stocks on October 9th, 07, which was the peak before the crash, you would have been down something like 60% at one point, and you would not have felt good. You would have felt like a dumb buyer. And everybody else would probably think you were a dumb buyer. Why did you buy that day, right? So, but if you had held on, if you had ridden the wave like I'm talking about with that diversified portfolio of S&P 500 stocks, your return to today would have been 10% per year. 10% per year for the worst buyer in the last, 14 years. Everybody else who bought in any other day and held did better. That was the worst. So listen, don't think too much. Don't overthink about when to buy. If you've got cash, if it's long-term beyond 5 years, buy your portfolio, get the right portfolio. And I'm going to talk about that on the next slide. And be prepared to ride the wave of the stocks going up and down. Now, what type of portfolio should you have? Now, I'm just sharing a couple of slides here with what I do, what I share with clients. This is not a recommendation for you. I don't know you, what type of allocation you need. But for my clients, manage their portfolios in one of two ways. They either manage it themselves. I tell them what funds to go buy. That's what this slide is. The next slide is where I manage the funds. So if my clients are managing the funds themselves, this is what I give them, an allocation across these 3 funds. They're from very conservative to very aggressive. Most people end up in this conservative, moderate, aggressive area where you might think. These funds are, the top one is US stocks. The middle one is international stocks. And the bottom one is bonds. That's just to average out the risk. So depending on your risk level, you would own one of these portfolios. Now, what have we done by buying these 3 simple funds? We've done a lot. We've tied your long-term portfolio to the overall growth in human activity. And we've created an allocation that hopefully you can live with through normal market times. And I see I'm coming up on time and I'm gonna go over, I apologize for that. There's just no way I can avoid it. But just for a minute or two, and then I'll stay on for questions. So that's what we've accomplished. What we haven't accomplished is the behavioral coaching that goes along. When the market crashes, yes, you can go back to your investment philosophy. You should go back to your investment philosophy, but you may have a hard time doing that for yourself. And so I do that for my clients as part of what we do. And of course, the ongoing managing of the strategy when the balances get out of whack, getting them back in whack, so to speak, as I discussed before. Now, if I'm managing portfolios for clients, here's what I use. I use DFA funds, which are similar to Vanguard funds. They own the same securities for the most part, just different weightings. And I get a little bit more detailed in the types of funds. So I have some micro cap and some small company international. And so you can see it's a little bit more of a detailed allocation. Now this is an aggressive portfolio. I didn't want to show all 5 because it just makes the slide go crazy, but this is just the aggressive. This is my personal portfolio and the portfolio of a lot of my clients as well. And it does outperform the Vanguard strategy. But of course, if I'm managing it for clients, I charge a fee for that. Some clients just rather do it themselves. But I wanted you to see there's really no difference. Both of these portfolios own the same securities. They're just in slightly different weightings. The important thing is to own a widely diversified portfolio and stick with it. Now, that's what I had prepared for you today. I didn't mention at the front, I should have mentioned at the front that what I'm offering you, because you registered and attended this webinar, is a free session worth $300. I do $300 coaching sessions. So I'm going to give it to you for free to talk through your risk tolerance and potentially the type of portfolio that's right for you. So that slide this one right here, the question of which one of these, I'm willing to give that to you for free, just in a conversation. All you have to do is click the link that I'm about to put in the chat. If I can type it right, I got to be quiet while I type. There it is. You can click that link. It'll take you to a risk tolerance test. You fill it out. It'll send to me your email address as well as the results of the test. I'll reach out to you and we'll schedule time to get together. You're also going to get an email with the slides in them. Download the slides, look at them again. I know I went through this quick, so you can flip through them a little bit more slowly, and let's get together and talk about it. Other resources, I have a podcast where I give weekly tips called Deliberate Money Moves. I also have a weekly blog and videos. You can always email me with any questions that you have. I'm happy to try to help. Our next webinar on February 3rd, everybody's favorite topic, how to reduce your taxes. We're going to talk through some ways to do that. I did mention this is not financial advice, not specific to you. Look at the bottom here. These are all the other webinars I have on file. If you're interested in any of those, shoot me an email and I will set you up with a review for that. Here's my email address, joe@bestfinlife. That's all I had. Oh, the link didn't appear in the chat because I only sent it to host and panelists. That wouldn't work, would it? There you go. There's the link. That's all I had prepared. I know there's a couple of questions here. If you have questions, please throw them in the chat or the Q&A, and I will be happy to stay on as long as questions are coming in. So here we go. All right, first question. Your slides tend to look at S&P 500, but that's a little different from Total World Stock Market Fund. Absolutely. What are your thoughts of total US market versus S&P 500 versus total world stock market? Well, good, better, best. How's that? Good would be the S&P 500. That's the 500 largest stocks in the US. Better, total US markets. That's all the stocks in the US, somewhere around, I think, 3,000. Total world stock market, best. That's the 10,000 plus. So if you look at, well, this is a good one here. You can see we've got large cap. So that's all the 500 largest stocks. Then we've got small cap, we've got micro cap, we've got international, we've got emerging. We're trying to get everything. It's about 12,000 companies there. Love to do that. The language you're using, Total World Stock Market Fund and Total US Stock Market Fund, sounds like Vanguard Fund language. Vanguard funds are fine, they're great. Other people like Fidelity and well, other firms have similar funds. They're fine. These are the funds that I think are best, and what I've seen has performed best. So it's what I use with my clients. The reason that I use S&P 500 for statistics is because the data is there. that's the only reason. It's the best data because it's the index that's been around the longest and the easiest to manipulate. So you can think of the international and the world funds moving somewhat in conjunction to that, although not exact. And that's why we have the different percentages. So hopefully that helps with that question. Let's see. I don't have any other questions yet. Any other questions? Please throw them in the chat or the Q&A, or to the person who asked that question, if I didn't answer fully, you can certainly follow up. I'm going to give it a minute or two and see if there's other questions. Again, I'm very happy for you guys that you guys attended and that you're interested in working on your finances. Congratulate you for that. Please continue to do so. Soak up all the resources you can. That's why I do these things, is because I've worked in the financial world for nearly 30 years, and my industry, the financial industry, does not treat families well. That's the easiest way I could say it. So I try to share the things that I've learned, and happy to do it. Okay. Oh, here's a follow-up question. I think my interest is just how does the World Fund compare to S&P over 100 years? Well, I don't know. So that's the problem. There is no World Fund that was around over 100 years. So there are academics who tried to recreate things, but there wasn't a Japanese stock market in 1941. Clearly, there wasn't a European stock market. So there's theoretical data, but I don't like using theoretical data. So okay, or even how does your portfolio compare as well, or at least for like the last 20 years? How does my portfolio compare to the S&P? Well, my portfolio includes the S&P. That's basically what this top line is. That's the S&P 500. That's those companies. I'm just expanding it to include international. How does it do if you include international or just US only? I think you have to look over time periods. Over the last 20 years, I think the US only probably beat it. But let me ask you this question. When you think about the next 20 years, or the next 30 years or 40 years, where's the potential for growth? Is the potential for growth greater here in the US, or is it greater somewhere else in a country or a region that is a little bit behind and continuing to develop? I would argue it could be better there. I'm not making that bet. I'm not making that call. That's why I'm not putting all my money there. But again, that's the question you got to struggle with when you come up with these percentages, and that's how I came up with those. So, I think the answer to your specific question over the last 20 years, the U.S. market has probably outperformed, but it's not a question that I've really looked at, and I'm not too interested in it because I'm more interested in the future. I know I look back, but I'm really looking back more to illustrate the purpose of investing in companies and how it works to invest in companies. So hopefully that helps. Hopefully that's satisfying to you. I don't know, maybe not. I got a smiley face, so I'm going to take that as it wasn't a big happy face, but just a regular smiley face. So I'm going to take that as maybe satisfied. So that's good.